Well, hey there, everyone. Happy Fed Day. Happy Wednesday, December 10th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a very, very rainy Seattle, Washington, Redmond, Washington, that is. I'm actually headed into downtown Seattle, weather permitting, to get to the Kraken game tonight, watch some hockey. It is a torrential downpour. It rains a lot in Seattle. If you've not been here, that is 100% true, but it's usually like a light, misty rain. Recently, it's been aggressive rainfall, and the problem is we're surrounded by a bunch of mountains and surrounded by a bunch of water and a bunch of rivers, and particularly in all the valleys we have in this area, including the valley I live in, if the waters get too heavy, things flood, and that's kind of where we're at. So we're pretty close to my town being an island, not quite there. So hoping I can get out and get into downtown Seattle and get back safely tonight. Fingers crossed, all is well, but I will be safe. Speaking of things to be excited about, market having a nice upside reaction post Fed meeting today. Highly anticipated 25 basis point cut as expected. Kind of a mildly hawkish sort of tone to the meeting. Chairman Powell sort of leaving the door open to future cuts. Market pricing in like one more cut in Q1. Certainly the market taking this as a wildly positive outcome. It's enough to push the S&P all the way up to 6,900 by about 3:30 p.m. Eastern. Did pull back a bit to end just below 6,900, but certainly feels like a risk-on feel to be certain. Now, what's interesting is, and the question as always is, now that that's happened, now that that's kind of priced in, what happens next, and what's the catalyst for further gains beyond there. For now, though, as a trend follower, I'm happily watching the trend move to the upside. With that in mind, we'll follow our normal pattern here. We'll look at the markets and see how they played out. We will look at the heat map and talk about some group and sector and stock themes. Then I have hand-selected some charts through the course of my day, and we'll go through theirs and reflect on what they might represent. Here's the chart, or the table of what happened today in the major equity averages. You can see the sort of quiet period until 2 p.m. Eastern. The initial reaction pretty positive as that 25 basis point cut, which was expected, was confirmed. Further appreciation through the press conference and really into the afternoon, with Powell's comments during the press conference, sort of giving additional optimism. I would say one of the big, while the 25 basis point cut, certainly expected, what maybe surprised some people is the fact that kind of back to QE, to quantitative easing, Fed announcing that they're going to be buying treasuries again. That's something that had been tapered off. So that, sort of implying a liquidity-driven bull market, which is, sort of a lot of the bull market off of the COVID low was driven by liquidity and the Fed buying treasuries and boosting up that market. Certainly seeming to be a little bit more of the same here. So with that in mind, S&P did touch 6,900, pulled back a little bit to close just below 68.87. That's enough to be up about 2/3% from Tuesday's close. The Dow was up 1.1%, closing above 48,050. The NASDAQ composite lagging, but still up about 1/3%. Mid caps and small caps very much taking this news in a positive way, both up 1.9 to 2%. So a strong kind of risk-on vibe to the major averages here today. The VIX moved lower, of course, right? Sort of holding steady around 17 until the Fed meeting, post-Fed, plunging lower as stocks rallied, and so finished just below 16 again. So we're down in the mid-teens. We are still in a low volatility environment. So what's interesting is, no real change here. The general structure of what we've been talking about with the S&P over the last couple weeks and really over the last couple months is primary uptrend. Keep an eye on the lines in the sand. Do we keep making higher lows? We've kept doing that. So that's why, generally speaking, I would say the trend has clearly remained positive. Have there been question marks that have come up? Very much so. But again, trend is positive, right? Undeniably so. And that's what I love about approaching the market from a momentum standpoint, right? Focusing on where the funds are flowing. It's not about predicting the future. It's not about knowing what's going to come tomorrow, because none of us do. It's about recognizing the trends, having good market awareness. And I think if you've had good market awareness, we've seen signs to be concerned about, but not enough to change the primary trend. And I think that's where we're at. Here. Our line in the sand at 65.50 still very much unbroken and holding steady there, about 300 points below current levels. So we'll remain constructive on stocks until that changes. All right, looking at some other asset classes, bond prices rallied in the afternoon. Bond markets closed at 3 p.m. Eastern as opposed to the 4 p.m. close for stocks. So after the Fed announcement at 2 and the press conference at 3, there's only about 30 minutes after the press conference starts. And then the bond markets are closed. The TLT did finish up 0.4%. Rates generally moved lower today. And you can see the 10-year yield, which did spike up to almost 4.2% in the afternoon, settled back and finished more near the lows of the day. So what's interesting is bonds actually were rallying in the morning, sold off after that initial announcement, but in the afternoon actually rallied back up. And you can see the TLT closed more toward the highs of the day. So through the course of the day, bonds rallying, rates coming off a bit, changing the general, or I guess disagreeing with the general trend we've been observing, which is weaker bond prices, stronger interest rates. We'll see what happens through the remainder of this week for sure. Gold and silver continue to have pretty decent moves. A lot of chop around the Fed meeting, but gold finishing toward the highs of the day, up about 0.4%. Silver continuing to lead gold, up another 1.6%. I interviewed Jeff Hirsch, author and editor of the Stock Traders Almanac, earlier today. That's with my editor. We'll hopefully get it to you out tomorrow. But Jeff and I talked particularly about precious metals. He was a little less constructive because gold and silver, and gold in particular, tends to have a pretty strong fourth quarter if you look back seasonally, and it's pretty much played out beautifully. But the seasonality going into the beginning of next year much weaker. So he was a little less optimistic of the sustainability of that current rally. For what it's worth today, moving to the upside pretty well. Crude oil prices moving higher, as did natural gas prices. Cryptocurrencies have been super volatile here recently. I mean, even more than normal. Bitcoin over the last 24 hours has kind of fluctuated between 92,000 on the lower end, 94,000 and change on the upper end. Currently at the lower end of that range, around 92,500. It's basically holding steady through the course of the day here. Ether price is slightly higher. Most of the top 10 coins more sideways than anything here at the equity close on Wednesday, December 10th. All right, looking at the 11 S&P sectors, pretty strong day, right? Breadth conditions were good today. Sector breadth, which is what we're looking at here, good as well. 10 out of the 11 S&P sectors finished in the green. Materials number 1, up 1.9%. Industrials number 2, up 1.8%. Consumer discretionary number 3, up 1.5%. What's not in those top 3? Technology. Technology was actually fourth from the bottom, up about 0.5% and lagging behind the Dow. On the downside, utilities were the only one that were down, and just slightly so, 4 pennies away from Tuesday's close. Real estate and consumer staples rounding out your bottom 3 performers for the day. Breadth pretty great today, right? And that's kind of what you'd expect given what we heard from the Fed. Lowering rates today, sort of expressing an openness to further rate cuts at the beginning of next year. All pretty positive. The idea of buying treasuries, certainly the market taking that pretty positive as well. All that means breadth conditions are pretty good today. On the New York Composite Index, which is that top line, 3-to-1 ratio, about 73% up to 25% down. If you look down at the S&P 500, a little bit better, 80% up to 20% down. It's about a 4-to-1 ratio. You get to the bottom here, you got like a 5-to-1 ratio in the S&P 500. With 85% of the mid cap, 86% of the small cap indexes moving higher. So small and mid, the SMID trade doing even better. The SMID trade has been lagging behind the large cap trade through the course of 2025. But for what it's worth today, breadth pretty good across the board. That is fair. And I would say that is not what we have seen up until today. I would say particularly the short-term breadth has been more negative than positive. This is a nice update breadth-wise. Looking at the Magnificent Seven and Friends leadership in the growth space, kind of split here. So while the breadth was great, while the major averages moved higher, Netflix sort of going through all this news related to Warner Brothers Discovery, and now it feels like today with what I'm reading, it's like either one of two things happens. Either this is a bid that doesn't work, which probably doesn't help Netflix because it was a missed opportunity, or Netflix has to take on a ton more debt to pay for it, which is the stuff I read today. So it's like either way, this doesn't seem to reflect well. I mean, and now this is short-term pain that I think they're betting on is going to create long-term success or long-term opportunity. Otherwise, you wouldn't even consider it. So, I mean, that's the play. But the short-term pain is certainly what we're feeling. So Netflix shares down over 4% today. Microsoft down 2.8%. Meta and Nvidia both down today as well. So on a day like today, when the breadth is very good, on a day like today, when generally speaking, it's a risk-on move, right? And it feels like investors are allocating capital to interesting ideas. I'm noting some of the stocks that they are not adding to, which is Netflix, Microsoft, Meta, and Nvidia. Interesting to see. And Nvidia now lagging, right? Broadcom over Nvidia has been a pretty decent pair trade this week. We'll see if that continues, but that's the vibe right now. All right. Our goal at Market Misbehavior is to help you make better decisions. Part of that is this market recap show where we just share with you what we learned today, highlight some of the key charts that we think are important, hopefully teach you some things about charting and technical analysis along the way. If anything that I show you here in the show makes you think of a question, please take a moment and use the comment section on our YouTube channel. We're planning an all mailbag episode on Friday, and we'd love to answer one of your questions on the show. All right, here's the heat map. Obviously a pretty good day, right? We haven't had one of these broad advanced kind of days in a little while where there's a lot of green on the heat map. We've had more mixed days a lot recently, but this is a pretty bullish move across the board. And you can see that particularly outside of the growth sectors. So sectors like financials, right? JP Morgan, which has been pulling back and making lower highs, now all of a sudden potentially making a higher low with a nice bounce higher today. American Express making a new all-time high today as it pushes just about 375 for the first time. Down in the consumer discretionary sector, it's the big names doing pretty well, but it's some of these other names that are starting to improve a little bit. Some of these names have been struggling quite a bit, like some cruise lines, like Nike types of stocks, which have been lagging for quite some time, maybe starting to find their footing. As I was looking through some of these names earlier, something like MGM pops them on the list. Head and Shoulders bottom pattern here in October and November, the neckline, the 200-day all being broken at the end of November. And look at how there's just further accumulation after that point. So some nice rotations in some sectors, some stocks that have been lagging and now starting to improve a little bit, which is actually kind of encouraging. Within the healthcare sector, we've been highlighting how some of the big leader names like Johnson & Johnson, like Eli Lilly, and others have been pulling back so far this week. All of those names kind of bouncing higher. So some of the names that have been working pulling back a little bit. Some of the names that had not been working starting to bounce higher. And then finally, in the industrial sector, Caterpillar making a new all-time high today. UPS. Testing $100 a share and potentially breaking out. I did grab that chart to share with you in a little bit. So I'm finding some really interesting names. If I'm looking for stocks making new 3-month highs, names like Dover, DOV, popping up on the list for the first time in a while. And I think when those kind of names start to pop up, you certainly want to pay attention to it. Materials may be one of the more surprising, if not encouraging sectors on here. A lot of these charts are not great charts. I mean, something like Albemarle looks more like a growth stock, looks more like a money center bank, and with this nice uptrend, does not look like most of the stocks within the materials sector. But it's worth highlighting some of those charts that have worked better than others. Nucor, Steel Dynamics, two of the steel names, sort of resuming their uptrend, or at least continuing that uptrend that we've seen for quite some time. What else do I want to talk about here when I'm looking at the heat map? I mean, generally speaking, right? I mean, this is a pretty constructive day. I'll tell you what we want to talk about. What did not participate? On a day like this, where the breadth is very good, on a day like this, when the major averages are up, I think from a stock picking perspective, it's always really helpful to look at what did not go higher. Because what that means is, for whatever reason, there's a company-specific issue most likely, or a thematic issue that is causing these names in particular to lag, right? So within healthcare, only 2 of the S&P names were down more than, a little bit. HCA Healthcare down 4%. Something's there. In the technology sector, Microsoft Apple, and neither of those going higher today. They're actually losing ground. In the consumer staples sector, Walmart and Costco both going lower. So, thinking about within, each sector, which were the names that did not participate, and just understanding why, because what this means is it's a broad kind of risk on day. Investors obviously super excited after the Fed meeting. We're putting bets on, we're putting risk back on, but we're deciding not to buy more Microsoft here. And that should tell you something, I think. What I've learned is that tells you something about the challenge for something like Microsoft. A day like today can't move the stock higher, something's going on. Now, it makes sense with some of these, right? Like Netflix going through the news-related events. T-Mobile's actually making a new 52-week low today, so it's been in the downtrend for quite some time. But I would encourage you to check some of these stocks that are not participating in a day like today. There's something going on there, and should generally give you caution about their opportunities versus elsewhere. Now, this is just one day. We'll see what happens tomorrow and Friday. Right now that the last Fed meeting is done, now that we kind of have that under our belt, are there buyers left tomorrow? Do we keep pushing prices higher? Does the S&P get above that all-important 7,000 level? Obviously, stay tuned. We'll continue to cover these charts and breakouts as they come. All right, let's continue on, finishing the show, looking at some charts together. So, pretty good day. We did not quite get into the green light section, but we got, literally to the penny right where we had highlighted that level. This is that traffic light scenario that we talked about for the S&P, basically saying, look, the S&P hit 6,900 back here toward the end of October, then pulled back to test our previous support level around 6,550. This gives us a pretty clear framework, at least it does in my mind, in terms of how to think about it, right? Above 6,900, which was literally today's high, that would mean we're clearing the late October high. That would mean a new all-time high for the S&P. That would be a risk-off sign. Now, obviously, we want to validate and see, is there stronger momentum to support that? Is there stronger volume to indicate that it's a real accumulation and not just a blow-off top? So there's things we could do to validate it, but from a pure price analysis kind of look, over 6,900 is pretty constructive. If we would go all the way down and break below 6,550, that's why we highlighted that level back here at the end of November. So look, market's still okay, but if we start breaking below 6,550, I wouldn't describe it as okay anymore because we're no longer making higher lows, right? We're starting to fail to hold previous support. That support did hold. At some point, if we rotate lower, 6,550, I think becomes a pretty important level to watch. And in the middle, I think it's still wait and see mode. I don't think it's a clear mandate of optimism or bullishness. There's plenty of reasons why I could cite to you as to why stocks could go higher. I also have plenty queued up as to why the market could go lower, right? In either of those scenarios, I think those would be easily explainable down the road. From a trend perspective, though, I still see this as sideways until and unless we can power above 6,900. Let's check the momentum and the volume for now, though. Obviously, pretty constructive way to go through the Fed meeting here. Breadth conditions, as I've highlighted, I've not seen as particularly constructive. Long-term breadth has been fine. It's the short-term breadth that has been a little more questionable. Today, with a nice rally in the constructive breadth, you can see we're up to around 55% of stocks in the S&P 500 above their 50-day moving average. That's a good sign that happened after the Fed announcement today. We get below 50%. That's where you have to just start to worry about the sustainability of an advance because there just aren't enough stocks that are remaining in a primary uptrend. This is encouraging. If we can stay above 50%, pretty good sign. Dow theory, we got to bring this up again because the equal weighted S&P with today's rally did make a new all-time high. That's the RSP, which is an equal weighted S&P 500 ETF that we track. If you have a platform like Bloomberg, if you have an access to an equal weighted index, I don't think it matters a ton. You're going to get pretty much the same chart that tracks that index very, very well. But the equal weighted S&P did in fact make a new all-time high today. The equal weighted NASDAQ 100 did not quite do it. It's still just a little bit below that October high. So if both of these can make a new high, that's called a bullish confirmed scenario. That's a really optimistic sign that accumulation is happening and it's a broad advance. If the equal weighted S&P broke out, which it did today, and if the equal weighted NASDAQ 100 does not break above its October peak, which is a very real scenario, that would be a bearish non-confirmation. It would be a Dow theory sell signal traditionally. So we'll keep an eye on this one for now. We have one check. We need two checks to confirm that that's in good shape. All right, we'll finish off looking at some individual stocks here and highlight some of the key takeaways. I'm drawn immediately on a day like today when it feels like everything went up, which most things did in the equity space, what didn't participate, right? Where were investors not allocating some capital when they're all bulled up and optimistic going into the beginning of next year? And I think the most noteworthy name here is Microsoft, or certainly one of them, right? Microsoft now failed to hold its 21-day EMA, which it closed above yesterday. Today, kind of gapping back downwards. The 200-day remains in play. The 38.2% retracement level from the April to July rally remains in play. That's around 473. The 200-day around 470. We're kind of right at that cluster of support, which also lines up to the swing lows from the end of November. If this holds, that's a pretty decent setup, right? And pretty good opportunity to potentially ride a retest of the previous highs. But a failure to hold 470, all of a sudden we've broken through all the important levels. The momentum remains quite negative here, sitting below 50 since the end of October. So overall, I would say this is a chart that is lagging. I'm inclined to wait for more of a sign of accumulation. It's certainly improving momentum, but worth noting it's testing some key support levels. And for today, not working too well. Had some questions from my market misbehavior premium members earlier today about volume. I just wanted to share with you one of the comments that we made. It was asked about semiconductors in terms of the volume characteristics. Right, there's no denying, if you look at the pure volume reading, right here in November, we're seeing stronger volume through the sell-off from late October to late November. From late November now to mid-December, we've seen obviously a nice reversal with the SMH round tripping back to its October high, and today making a new all-time high for the SMH. But the volume has been much less positive, right? Look at the heavy volume back here around the turn. Look at the much smaller volume, much lighter volume during this advance. So the pure volume reading tells you it's been a lot lighter, which is concerning. But the accumulation distribution is more bullish. The Chaikin money flow is more positive. That's because those kind of indicators look a little bit more about the relationship between price and volume. And they see a lot of these up closes, and you're able to calculate the volume there. So these are more looking at the trend in volume over time. So if you have a bunch of days where we're closing higher and those days have enough volume, that's enough to suggest that the trend in volume is fine. So not perfect. I mean, ideal situation, a rally would be on heavier volume. That's kind of the classic Edwards and McGee, John Murphy kind of approach of you want big moves supported by heavier volume. We're not seeing that on semiconductors. I would say some of the more evolved volume indicators, derivatives of volume, looking at trends in volume or comparing price to volume movements to sort of validate that. Those are a lot more constructive here. So I'm not that concerned about the strength of the uptrend in volume terms because of the volume indicators that remain fairly constructive at this point. All right, let's finish off looking at some more individual charts, particularly some ones that look pretty good here. I think we're going to finish off with 2 or 3 fairly constructive charts here. Western Dig making a new all-time high today. WDC was up another 7%. I mean, charts like this remind me, right? I think we spend way too much time arguing about whether being, you're bullish or bearish on the broad market. And for me, having spent a number of years working with professional money managers who are more stock pickers, the macro call was much less important as finding the names that are doing well, regardless of the macro situation. And for me, that kind of helped me learn to balance my approach. You're always going to want to know the chart of the S&P and think about allocation, think about how much risk you want to put on. But I finish off every episode of this show with the phrase, it's always a good time to own good charts. And that is a sentence I started saying just to remind us all, it doesn't matter what you think the S&P or the NASDAQ are going to do. If a chart like WDC is a good chart, you should strive to have charts like that in your portfolio because they're good. And it doesn't matter what the broad market is doing. When good charts deserve a place in the portfolio. And when the charts aren't good anymore, that's when you want to start to lighten up. So look at the pullback to the ascending 50-day moving average. Look at this hammer candle that occurred right at that test of the 50-day. I think it's a great way of combining sort of a trend following mechanism with a short-term signal like a candle chart. We've now seen the rally back up to retest and push higher. So semiconductors making new highs, Western Digital making new highs in the technology sector. That's all good. If there's any potential asterisk to how awesome that chart is, it's the momentum, right? So in October, we can see the RSI is around 85. Here in November, we see the RSI tops out is with the phrase I'm trying to get out of my mouth, tops out around 75. Here, we're currently at an RSI of around 69. Now, it's not done yet, right? We could see further upside on stronger momentum, but that's what you want to watch on charts that look very, very strong is be wary of stocks making new highs on weaker momentum. Unsure whether or not that's going to happen for now. I think the chart is innocent until proven guilty. Also, oil and gas, this is equipment and services. I often show the OIH, which is one of the ETFs that I follow. This is a similar kind of oil services ETF, ticker XES. This is the spider version of that Van Eck ETF. As I was talking with Jeff Hirsch of the Stock Traders Almanac earlier today, and again, we'll hope to have that podcast episode out for you very, very soon. But when we do, you will hear when we talked about it. Jeff particularly highlighted energy as showing some potential seasonal strength, but certainly showing some strong trends as well. And I love that combination of seasonal tendencies, but trend strength now and your expectation of the trend. XES, the oil equipment and services ETF, is making higher highs and higher lows. Look at all these pullbacks to an ascending 50-day moving average. So it's a little more volatile, but it's working. And the price is above all these upward sloping moving averages. Momentum is in the bullish range. That's a good chart getting better. Two more charts, I think, to finish things off. Nike, I mean, not quite there. Nike is maybe a not quite ready chart, but getting close, right? So, I mean, happy to highlight charts like XES and charts like Western Digital, kind of in primary uptrends, up and to the right, kind of long and strong types of charts. But the market isn't all those kind of charts. There are others as well. Nike is an example of a name that's starting to improve. But I think Nike is a really important example to go through because there's sort of two different ways I could see this chart playing out. And either one, I think looking back in hindsight will make a ton of sense. But right now, which way we go from here, I think is pretty unclear. Let's start the story with what we did. The April low to the July peak, we retested that peak at the end of August. Then we start going downwards. We bounce off of the 200-day. We break below. We test the 200-day from below. We continue lower. Now we're back up to testing the 200-day from below again. Look at the Fibonacci retracement levels. This is perfect example, textbook example of how these levels can be valuable, particularly if you're a swing trader. So if you look at the sell-off right off of that peak, 38.2% of the way is basically retracing that April to July rally. So thinking of that as a place where you potentially might have a swing worked out pretty well. Lined up with the 200-day moving average, you have a couple different indicators all agreeing on that level. We break that eventually. The 50% level is right at 65. That was that next bounce. We finally get to 61.8%. Granted, we went a little bit below, but didn't really follow through much below that breakdown. And so that was sort of the end of the move. So on the upside, getting back above some of these levels would be pretty bullish, right? So we've been below the 50-day moving average for quite some time. We just broke above there today. We've been below the 200-day moving average since October. We're not quite there, but we're very, very close. So we're potentially bouncing off of a key Fibonacci support level. We're now potentially breaking above that 200-day moving average. So I would say breaking above the 200-day, breaking above this Fibonacci level, that would be a really bullish follow through to the upside. But here's the other thing, right? On the other hand, this could be sort of a big, and I'll draw out the bear scenario in bright, bold red so you see what I'm doing. What if this is a big kind of bear flag pattern, right? What if this is a sell-off and then a counter trend move of higher highs and higher lows? A bear flag pattern is confirmed if and only if you break below the lower trend line connecting the lows, right? So I would say, Nike below 61.50, which would clear that pattern, which would clear the 61.8% level. Very negative chart, implying at least a retest of the April lows from using that as a measured move. However, if we would break above the 200-day and continue above 68, 69, pretty bullish follow through. Then it's not a bull flag, then it's a breakout. So if you've been avoiding a chart like Nike, I think we're right at that point where you need to wait and see which way this move actually resolves. This could be a bear flag pattern that would be confirmed with a break below the lower trajectory here. It could be just a nice recovery, higher lows building up for a breakout, but we won't really know that. And we won't really know that the bear flag is invalidated unless we break above like 68 or so to clear those levels. So really important chart. I think a really helpful one if you're learning some of these price patterns, just want to think about what the chart is telling you. But hey, let's finish on a positive note. What do you want Nike to look like? I would think something like UPS, right? Look at the stall at the gap higher, stalling out at the 200-day moving average, pulling back, this sort of coil triangle type of pattern. now breaking out, and over the last couple weeks, continuing this upswing. It's up almost 3% today, but I think that just continues to reaffirm the new accumulation phase that UPS is pounding out. On this kind of chart, I keep an eye on the 21-day EMA as an initial sort of stop, an initial alert, an initial sign that this new uptrend may be faltering. But for now, strong chart getting stronger. Folks, that will do it for today. Thanks for joining me here on a Fed Day for a quick review of the charts and how they evolved. Again, pretty bullish setup. No real change to our general assessment of the primary trend being positive. Question marks not really leading to any breakdown. To the contrary, we're seeing potential renewed strength. We'll keep an eye on those charts and levels and some of these potential breakouts. Keep watching our show, and we'll let you know if there's any change. In the meantime, I will say have a fantastic evening. Go Kraken. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts.